Well, welcome into a daily editorial here on the KE Report. I am chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold. And Jordan, one thing that you and I have been talking a lot about, and in all fairness, what a lot of people have been focusing on, is Fed policy. And for us, when it comes to how the precious metals will react, a lot of the precious metals bulls are pointing to the fact that it really seems like the Fed is going to pause on their rate hikes sometime next year. Maybe they're only going to get this December rate hike done and then they're going to pause, or kind of the boat that I'm in is that they're going to get one, probably two more rate hikes next year and then pause as they're closer to that 3% level. But overall, for the bullish case for the precious metals, it's not even so much about a pause in rate hikes, although that is good for the metals. It's more about when the Fed actually switches course and starts cutting rates. That's when a full-on bull market could really happen for the metals. Just look back to 2008 when the metals bottomed and gold went straight up for about 4 years. What do you have to say to your subscribers and to our listeners about this whole concept of a pause? Yes, good for gold, but the real bullish scenario is an actual cutting in rates.
Well, first of all, Corey, a pause has already been discounted, I would say a great deal by the market. I mean, we'll see how much more room this current strength has to go. But if you look at Fed funds futures coming into the week, at the end of last week, the market was essentially only pricing in one more hike, and then it was even pricing in half of a quarter point cut for 2020. So the market was only pricing in one more hike for the cycle. So with that said, the market basically is pricing in a pause for the entire 2019. So, and that supports the current strength that we've seen in precious metals. But ultimately, looking at all these historical examples, and history is a real powerful indicator. If we look at the current context and then we look at the historical examples, it strongly argues that, as we've been saying for months and months, that we will see a bottom when the Fed stops hiking. And this strong performance that we see after the Fed stops hiking coincides with the start of rate cuts. So if we're looking for a big bull market in precious metals, which we are, that is going to be triggered, you could say, by the start of rate cuts from the Fed. So I don't see I don't see precious metals. I don't see this being the start of another January 2016 here, this strength. I mean, there's several reasons for that, but on the fundamental side, with respect to the Fed and rate hikes, it's good that long-term yields have failed to break out and they're coming down. But with respect to short-term yields and the Fed funds, we want to see the Fed signaling that it's going to start cutting rates, and that's really the catalyst for the start of a bull market. Now, if December is the last hike, then I don't think we're going to see. I mean, I'm looking at GDX right now, that September low. If December is the last hike, I have a hard time seeing GDX trade down below that September low. But as you noted, if the Fed is going to hike in December and there's another hike next year, then at some point that's going to, as the market prices that in and discounts that, that's going to put a lot more pressure on precious metals, because now the market is basically factoring in only one more hike over the next 13 months or so. So it's pretty simple for precious metals. It depends on Fed policy, and also the S&P 500 is going to play a great role because that reflects the economy. And if the stock market is strong, that's going to raise Fed hike expectations. But if the stock market is weak, that's going to lower Fed hike expectations, and that's bullish for precious metals.
Yeah, it's all kind of the big picture theme, right? Where precious metals are kind of a sector that is going to react and start to get a more bullish scenario when some of these other areas do start to break down. But as you said, we're all waiting for that further rollover in the S&P, plus for the Fed to, first of all, pause. And it's not going to be a pause and then all of a sudden start cutting. That's just not what the Fed is going to do. They're already trying to warn the markets, but discussing some of this recent strength that, again, some of the bulls are pointing to. Even today, we have GDX moving up quite nicely. GDXJ is moving up. Even SIL is moving up. But overall, GDX is the best chart compared to GDXJ and SIL. It's one of these stories where still some of these stocks are stuck in the mud, but some of the majors are starting to perform better. Do you have any thoughts on this?
Well, the majors performing is obviously a positive. I mean, if we go back to, you look at the January 2016 bottom, the majors actually bottomed, I believe, in September 2015. So the majors bottoming first is a good sign. I'd have to look at the internals back to when they bottomed in the summer of 2015. It could be similar to now, where the breadth for the sector is really bad overall. It's really bad, even though the majors started to bottom at that point in the summer of 2015. And then it took some time for the rest of the sector to bottom and for breadth to get pretty strong, because that's another thing that you really want to see coming out of bottoms is you really want to see strong breadth. You really want to see strong participation. And just looking at the breadth in the Huey, for example, there's 23 stocks in there. And as of yesterday, I'm looking at some notes I scribbled down, but as of yesterday, I think we only had 23% of that index trading above the 200-day, and then it was only 20% of juniors. I have this junior basket that I track. So on the one hand, that tells us that we could actually possibly get some more strength from the miners here because breadth is weak. But at the same time, it kind of tells us that, breadth is not strong enough to push this market into a new bull phase. Like you would expect after the rally that we've had for a couple months here, the strength we've seen over the last month, like you would expect breadth and participation to be stronger than it is right now. So I know that's a lot to take in, Corey, but really the where we're sitting here and now, it kind of depends on, the next move is, are we going to see the gold price go lower and these strong seniors are going to start to correct and go sideways for a little while, and then the sector as a whole sells off quite a bit? Or are we going to see the majors, which are leading, are we going to see them retain the strength that they have and see the rest of the sector, which has been pretty weak? Are we going to see that, those stocks, are we going to see them start to strengthen and then eventually, push the miners as a whole above the resistance levels that they're starting to test here and now?
So, Jordan, if, say, you do take a more bullish scenario here and you do start to see more leadership and more follow-through on a broad sense of the stocks, how quickly can stuff start moving to the upside? Kind of taking into account what we were just talking about, the Fed and the belief that they're not just going to stop their rate hikes and then start hiking again. Could this be a process? Could this take, say, a year for the right scenario to build?
Yeah, I mean, that's a great question because it's something I've been thinking about. If the Fed is going to pause for the entire 2019, at the beginning of the year, we could see range-bound action. But if the Fed is going to pause for the full year, I would think that their first cut is probably going to be early 2020. And then so the months leading up to that, the market would start to discount that. So even in that scenario, I think you would start to see precious metals strengthen in the second half of the year, into that first cut in early 2020. I mean, there's no hard and fast rule for all of this, but generally what I want to see is strong breadth, strong participation from most of the stocks in the sector, because when you get really strong moves higher, they're accompanied by really strong participation. And, over the last couple of months, we just have not seen that. This just, I hate to use the term bull and bear market at this point, but, the recent strength has really not been a bull market rally per se, because the breadth has been so weak. Well, let me step back for a second. Fundamentally, if this is the Fed's last hike, then the scenario you could see is where it takes several months for these weak stocks in the sector. It takes several months for them to kind of correct a little bit, bottom out, and then we're several months down the road and you see participation and breadth starts to look better, even though the sector hasn't broken out and into a bull market. So that's one scenario to consider. It also goes back to where you want to be a stock picker at the same time. And you don't necessarily just want to buy the market yet, because if you can pick the right stocks here, then you can probably outperform next year, even if it's going to take the sector a little while to go up into bull mode per se. So I know that's a lot. We're looking at a lot of different factors here, Corey, but and also a lot's going to depend on the stock market, honestly, because if the Fed is going to pause for a while, then a lot is going to depend on the stock market. Because if the Fed is in a pause and the stock market starts to strengthen, then the market will say, oh, well, maybe odds for the Fed hiking are going to increase. But then again, if the stock market is really weak and it's rolling over and the economic data is bad, even if the Fed is in a course of pause, because of those things, the market would start to price in rate cuts sooner than we'd expect, and that would be better for precious metals. So I think once we get the Fed in, when they pause, a lot is going to depend on the economy and the S&P 500 at that point, and then that precious metals can kind of trade based on what's happening with that, because those things are what are going to impact Fed policy and tell us how soon are they going to cut, or are they going to continue to be in this pause mode for a while.
Exactly. So much does depend, again, on those U.S. markets. But I think what we're outlining here is that it's going to take some time for, first of all, the market to digest whenever the Fed does pause. And then so much depends on what happens after that pause as to what the expectations are going to be for the Fed, either getting back on that rate hiking train or truly pausing for a long period of time. And who knows, maybe dropping into a recession and having to start cutting rates and start a whole nother QE program. This is something that's going to develop all through next year, but the change from this year is that now, instead of rate hikes well into and throughout 2019, those seem pretty much off the table. So some interesting nuances for, I think, those precious metals bulls to consider is that this is not going to be a straightforward, smooth transition, and it very well could take some time. But most importantly, pay attention to those U.S. markets and then follow along with what the Fed is going to do. Jordan, good chatting with you. There was a lot of information here. If anybody wants any more information on Jordan's newsletter or has any topics that they would like us to discuss, please comment, or even better, email me at fleck@kereport.com. Jordan, thanks again for your time.